Welcome, and thank you for joining us on the deep dive. This is your trusted space, really, for cutting through all that information noise out there. We aim to bring you those truly valuable, carefully extracted nuggets of knowledge. We meticulously sift through articles, research, expert analyses, you name it, distilling everything down into something, hopefully, genuinely insightful and immediately applicable just for you. No overload, just pure, concentrated understanding. We respect your time and your curiosity. Today, we're embarking on a deep dive into a subject that impacts every single one of us, every single day, often in ways we don't even consciously realize. The topic is the future of money, a behavioral scientist's predictions for 2030 behavioral finance. Just maybe pause for a moment and consider how rapidly the landscape of our financial lives is changing. I mean, really changing. The way we earn, spend, save, even how we think about money. It's undergoing this profound transformation. And here's the critical part, I think. It's not just about, fancy new technologies or complex economic models. It's fundamentally about us, human beings, navigating this massive shift.
So this deep dive is designed to offer you a unique shortcut, a way to get well informed about what's coming, how these changes might ripple into your personal financial decisions, and why understanding human behavior is, well, now more than ever, right at the very core of it all. And to expertly guide us through this fascinating and, let's be honest, sometimes bewildering terrain, we have our brilliant expert with us. They bring, over a decade of really profound experience unraveling the complexities of financial psychology, consistently offering insights that blend that sharp professionalism with a wonderfully relatable touch of humor, which I always appreciate. They are here to help us decode what the world's leading experts are anticipating for the financial landscape by 2030, all filtered through that indispensable lens of human behavior. So get ready, because we're about to uncover some truly illuminating aha moments, I hope.
Thank you for that excellent introduction. It's truly a pleasure to be here for this deep dive. It's such a compelling topic. And what's truly fascinating here, and I think often overlooked, is precisely how much our own psychology will implicitly shape this future, whether we consciously realize it or not. We often think of finance as this purely rational domain, right? A meticulous game of numbers and logic. Yet the human element, well, it's always been the ultimate wild card, introducing, let's say, delightful chaos and unexpected outcomes. And as we plunge deeper into this increasingly intricate digital era, that human element, it's only going to become more pronounced, more influential, and frankly, more fun to dissect.
Okay, let's unpack this then. Before we sort of fast forward our mental clocks to 2030, we really need to establish a solid foundation. For those who might be encountering this concept for the first time, or maybe just need a quick refresher, what exactly is behavioral finance? And why is this field, this blend of psychology and economics, why is it so incredibly crucial right now in our current financial climate?
That's a perfect starting point, yeah.
Yeah.
At its very essence, behavioral finance is the rigorous scientific research that investigates how our deeply ingrained cognitive biases, our sometimes irrational emotions, and various social influences actively shape and, let's be clear, often distort investor decision-making. It stands in direct, quite fascinating contrast to classical financial theory, which, for decades, operated under the assumption that all market participants are purely rational actors. Vulcans.
Right, the Homo economicus idea.
Precisely. Always making optimal choices to maximize their wealth. Behavioral finance, quite simply, addresses the often uncertain, frequently irrational, and undeniably human behavior that we consistently observe in real-world markets. It's the field that acknowledges we're not always perfectly logical, especially when it comes to our money.
So it's moved way beyond just academic theory now. It's practically playing out right in front of us, influencing headlines and, our own pocketbooks. Can you give us some concrete real-world examples where we can clearly see these principles in action today, things people might recognize?
Absolutely. The practical applications of behavioral finance are, frankly, they're everywhere you look once you start noticing. Think about the wild roller coaster ride of the meme stock phenomena a while back.
Oh, yeah. GameStop, AMC.
Exactly, where collective sentiment, social media buzz, and this powerful sense of community, far more than traditional valuations, drove incredible and often, let's face it, irrational market movements. Or consider the extreme volatility we've continuously witnessed in the cryptocurrency markets. I mean, those ups and downs. These markets are heavily influenced by a potent cocktail of psychological factors. The fear of missing out, FOMO, as it's known.
Everyone feels that sometimes.
Oh, definitely. People jump in because everyone else seems to be making a fortune. Then there's classic herd behavior, where individuals follow the crowd without, independent analysis. And often there's this powerful, almost religious belief in a particular asset or coin. We even see its influence in areas like ESG, environmental, social, and governance investing. which has become huge.
Right, investing with your values.
Precisely. Here, personal values, ethical considerations, a burgeoning social consciousness play a significant role in investment decisions, sometimes overriding purely financial metrics. It's about investors trying to align their money with their conscience, which is a deeply human psychological driver. And these applications, by the way, they extend across a vast spectrum of the financial world. It's not just individual investors. From retail investing, where, individual biases can quietly erode personal portfolios over time, to institutional investing, where large funds have to navigate the collective decision-making and potential biases of many individuals on a committee. Behavioral finance is now vital for robust risk management strategies, for refining the algorithms used in quantitative and algorithmic trading, and perhaps most profoundly in the rapidly evolving fintech sector, which is increasingly being designed with human behavior, human psychology, baked right in.
So financial analysts aren't just crunching numbers anymore.
Not solely, no. They're also keenly analyzing psychological patterns, market sentiment, trying to understand the why behind the numbers. The real takeaway here for you, the listener, is that understanding behavioral finance isn't just a nice-to-have skill in today's financial landscape. It's rapidly becoming an absolute must-have, really. It empowers you to navigate these complex markets with a far greater degree of awareness, to critically recognize these pervasive biases, not just in market trends or in what others are doing, but crucially, in your own personal financial choices.
That self-awareness piece seems key.
It is. This self-awareness, in turn, allows you to make more deliberate, more informed, and ultimately more effective decisions about your own money and your future well-being. It's like having a secret decoder ring for your financial brain. Helps you understand why you really make the choices you do.
I like that analogy. Okay, so now that we have that foundation, here's where it gets really interesting, I think. We're going to pivot now to a macro view of the future. We're drawing some compelling insights from a fantastic source. 30 Voices on 2030, the new reality for financial services, by KPMG. This report gathered perspectives from a diverse mix of industry leaders, CEOs, thinkers, regulators across the globe. Let's delve into what these experts are predicting for the financial landscape by the end of this decade. It sounds like a world away, but gosh, 2030 is really just around the corner.
Indeed, this KPMG report offers an incredibly comprehensive and sometimes startling look into the near future. And it's clear from reading it that the financial services landscape in 2030 will be fundamentally, almost unrecognizably different from what we know today. Firstly, we absolutely have to talk about the acceleration of digital transformation. This is huge. The COVID-19 pandemic, far from being just a temporary disruption, acted as this massive, irreversible catalyst. It significantly sped up changes that were already underway, sure, but it put them into hyperdrive, driven by rapidly evolving customer expectations and a wave of new market entrants like fintechs. By 2030, the report suggests the terms digital and transformation won't even be standalone buzzwords anymore.
They'll just be.
How
Things are.
Exactly. They'll be so deeply ingrained, so utterly ubiquitous, that financial institutions, particularly banks, will simply behave and operate like technology companies. As leaders like Deborah Young of the RegTech Association and Nadine Shakar of State Street highlight in the report, this isn't just a possibility, it will be a foundational given. The real insight here: your bank is effectively becoming a tech company that just happens to handle money. That's the mental shift.
It's a profound shift, really. And I imagine hand in hand with this digital acceleration comes a renewed, maybe even intensified focus on the customer.
Precisely. That leads directly to the second major theme, the primacy of customer centricity and trust. The KPMG report describes consumers in 2030 as socially purchase, cynical, and predominantly brand agnostic. That's quite a description.
Cynical and brand agnostic. Wow.
Yeah. They will hold financial services to extremely high, almost uncompromising standards. For any brand to survive and thrive, it will absolutely depend on earning and meticulously maintaining trust. And what does trust mean in 2030? Well, it means diligently protecting customer data, valuing individual privacy above all else, and overtly demonstrating a clear purpose that extends far beyond just, maximizing profit. The legacy of past financial crises, events like the Royal Commission in Australia mentioned in the source, underscores this depth societal shift. Trust in financial services is no longer just about the safety and security of your money, though that's still crucial, of course. It's now fundamentally about transparently acting in the customer's absolute best interest and rigorously safeguarding their most sensitive digital data.
Which feels like a much higher bar.
It is, and the report suggests many banks currently fall short of these escalating expectations, leading to a palpable disconnect and a lingering lack of trust among consumers. By 2030, anticipating customer needs, genuinely aligning with their personal values, and demonstrating real purpose will not just be good practice, it will be absolutely critical for survival. Non-negotiable.
So the key takeaway for you, listening right now in this macro view, it feels like your financial decisions are no longer just about numbers on a screen. They're becoming deeply intertwined with your personal values, your digital identity, even how you interact with your favorite brands online. Is that fair?
That's an excellent summation, yeah.
Yeah.
Your personal ethics and your digital footprint are becoming just as important to your financial future, in a way, as your credit score used to be.
Wow.
And this concept of intertwined values then leads directly into the third major area, democratized data and hyper-personalization. The prediction is that customers will be far more willing to share their data in the future, but, and this is a big but, this willingness will be conditional.
Okay, conditional on what?
It must be in exchange for demonstrably more personal, more tailored, and genuinely valuable experiences. A clear quid pro quo. By 2030, the report speculates, nearly every individual will likely possess a robust digital identity. Think of it like a secure, portable personal data vault that you control. This digital identity will be the key, enabling truly personalized financial services and products for everyone, including, crucially, the previously unbanked or underbanked populations around the world. This could be a massive driver for inclusion.
How would that work exactly?
Well, initiatives like open banking and the consumer data right, which are already rolling out in various forms, will further codify and facilitate this secure data exchange. This fosters dynamic partnerships across various industries, as Stephen Worrell from Microsoft Australia points out in the report. The vast data exhaust generated from our everyday activities, e-commerce, social media, even e-gaming will be ethically harnessed to power entirely new credit and risk models, turning seemingly disparate insights into alternative, more inclusive ways of evaluating financial health and offering bespoke services.
Using different data points to build a financial picture.
Exactly. Moving beyond just traditional credit reports. Following this, we'll likely witness the significant rise of embedded finance and integrated ecosystems. This is a really interesting one. Banking, for instance, will increasingly become, and the report uses these words, invisible, connected, and purposeful.
Invisible, what does that mean? Less visiting branches, I assume.
Way beyond that. It means financial services will be integrated directly into our daily interactions and purchase journeys, rather than existing as a distinct, separate activity you consciously undertake. Think about how you might purchase travel insurance automatically, seamlessly, when booking a flight online. Or how vehicle financing is often offered right there at the point of sale for a car.
Yeah, it just happens as part of the main thing you're doing.
Yeah, precisely. Financial services firms will need to develop incredibly robust platforms and partner extensively with fintechs, insurtechs, even big tech firms like Google or Amazon to offer these truly integrated end-to-end services. The focus will squarely be on delivering a seamless, intuitive customer experience, not just pushing individual products and pricing. It's about money flowing around your life, rather than your life having to flow around managing your money.
So it's less about you actively going to your bank, digitally or physically, and more about financial services coming to you, exactly when and where you need them almost unnoticed sometimes.
Precisely. That's the vision. And this paradigm shift will inevitably drive an evolution of traditional banking models. The familiar, diversified conglomerate banking model, where one giant institution tried to do absolutely everything. That will largely recede, according to these experts. Instead, banks will likely simplify. They'll focus on core banking services like deposits, lending, payments, while investing heavily in advanced technology platforms. And how will they get those platforms? Often by strategically acquiring nimble fintechs, absorbing their digital capabilities, and importantly, their talent.
Buying the innovation rather than always building it in-house.
Often, yes. Conversely, we'll see the accelerated rise of what the report calls tech-fin firms. Think of it this way. If a fintech is an agile startup specifically designed to disrupt or enhance banking services, a tech-fin is more like an Amazon, a Google, an Apple, maybe an Alibaba. These are massive platform businesses. They leverage their colossal user bases and sophisticated technological infrastructures to offer auxiliary financial services, often deeply integrated into their existing non-financial platforms, like payments within a social media app, for example.
So the lines are blurring even more.
Completely. Fernando Murillo of Mushrek wisely notes in the report that while fintechs are brilliant at identifying and solving very specific customer problems, traditional banks will likely remain absolutely crucial for delivering comprehensive end-to-end solutions, especially regulated ones. This fosters a complex but collaborative environment he calls co-opetition.
Co-opetition, I like that. Cooperating and competing simultaneously.
Exactly. It's less a simple battle, more like an intricate dance between incumbents and new players. And perhaps the major force driving systemic change across all these areas will be ESG, environmental, social, and governance. ESG criteria will become deeply embedded in virtually all lending and investment decisions, moving rapidly from a niche concern or maybe just a PR exercise to a core driver of business.
So real teeth behind it now.
That's the prediction. There will be a strong, deliberate focus on impact potential, actively directing capital allocation towards businesses and projects that demonstrate clear, positive contributions, not just financial returns. And critically, beyond the environmental E, social and governance issues, the S and G, will be equally critical. This directly reflects increased customer and societal demand for justice, equality, and ethical corporate behavior. This shift is so profound that we're already seeing new metrics emerge. The report mentions EBITDA earnings before interest, taxes, depreciation, amortization, and carbon.
Adding carbon impact right into the core financial metric.
Exactly. As highlighted by Eddie Listorti of Viridios Capital, it shows how carbon impact is becoming a core measure of financial performance and risk. ESG capabilities are rapidly becoming a foundational element of a financial firm's competitive advantage. It's not just do good, it's increasingly do well by doing good. That link is getting stronger.
That's a powerful shift, embedding societal impact directly into the bottom line like that. But surely this transformative future isn't without its own set of significant key challenges, right? You can't all be smooth sailing.
Oh, far from it. This brave new world presents very significant hurdles. Firstly, and perhaps most obviously, cybersecurity. It remains a formidable Achilles heel, as the report puts it. As financial services become ever more digital, interconnected, embedded in everything, the attack surface for cybercrime expands exponentially. We're talking about increasingly professionalized cybercrime rings, sometimes even state-sponsored actors, deploying incredibly sophisticated tactics.
It feels like we hear about major breaches almost weekly.
Exactly. So robust security architecture, recruiting and retaining top-tier cybersecurity talent, and forging strategic partnerships are no longer just IT expenses. They are foundational pillars of customer trust, and indeed a competitive differentiator. Lose trust on security, and you lose customers, period. Secondly, and perhaps even more stubbornly difficult to address, are the legacy systems and legacy thinking deeply entrenched within many incumbent financial institutions.
The old ways of doing things.
Precisely. Both technologically and culturally. It's like trying to upgrade a skyscraper's entire plumbing and electrical infrastructure while millions of people are still living and working in it. It's incredibly complex, immensely expensive, and fraught with risk. Overcoming these deeply embedded barriers requires not just massive investment in new technology, but often a complete cultural overhaul to genuinely foster innovation, agility, and adaptability. That's often the harder part.
So boiling this all down, what does this complex, fast-changing future mean for you, the individual, trying to navigate this brave new financial reality? It sounds like we're heading towards a world where our money is managed, moved, maybe even earned, in ways that demand a whole new level of awareness from us.
Indeed. I think it means you can realistically expect more personalized, more deeply integrated financial services. Services that genuinely anticipate your needs and potentially align better with your personal values. That's the upside. But, and this is absolutely crucial, it also means a greater constant need for vigilance regarding your data privacy and security. You'll need a deeper understanding of the underlying purpose, the ethical stance, and the security measures of the institutions you choose to trust your money and your data with.
So more homework required for us consumers.
In a sense, yes. Your financial decisions will become more interconnected with your daily life, your digital identity, and your personal ethics than ever before. The insight here is that you'll need to be an incredibly informed, proactive, and discerning participant in this rapidly evolving financial ecosystem. You can't just be passive anymore.
Okay, that sets the stage brilliantly. Now let's zoom in even further. Let's move from that macro overview of the industry to the micro level, focusing intently on the fundamental psychological principles at play. We're talking about our human brain, right? That incredibly complex and, let's face it, often quirky organ. How is it wired when it comes to money, especially in this rapidly changing digital world? It truly feels like the digital realm, with its instant gratification, endless choices, constant notifications. It often amplifies our inherent human quirks, making truly rational decisions even harder sometimes.
It absolutely does. Our brains, despite their astonishing capabilities, are simply not perfectly logical machines. They never have been. They come with inherent cognitive limitations in decision-making. We are not, and never have been, the purely rational economic actors that classical theory once assumed. Decades ago, Herbert Simon, a true pioneer in this field, introduced the concept of bounded rationality. He actually won a Nobel Prize for it.
Bounded rationality, meaning our rationality has limits.
Exactly. His theory proposes that our decisions are inherently limited, or bounded, by three key factors. First, the sheer complexity of the problem itself. Financial decisions are often incredibly complex. Second, our finite cognitive capacity, our mental bandwidth, if you will. We can only process so much. And third, the limited time we often have available to make a choice. We're often rushed or under pressure. Building on this, the legendary psychologists Daniel Kahneman and Amos Tversky further demonstrated that people systematically deviate from purely rational decision-making. Their groundbreaking prospect theory, for which Kahneman later received a Nobel Prize, Tversky, having sadly passed away, revealed how we make choices based on psychological value and perceived losses and gains.
How we feel about the potential loss or gain.
Precisely. Rather than just objective outcomes. We're often influenced by predictable cognitive failures or biases. These insights are absolutely foundational to understanding why we often don't do what's objectively best for us financially, even when we know better. Think of it. Our brains are powerful, but they have their unique shortcuts, their heuristics, their biases, especially when money, with all its emotional weight, is involved.
So it's not that we're intentionally irrational or that we lack intelligence. It's just that our brains have these natural limits and specific ways of processing information, especially when faced with overwhelming information or tough choices, which feels like practically everyday life in the digital age, right?
Exactly right. And one of the most impactful limitations, especially relevant to financial well-being, is the profound effect of scarcity on our cognitive bandwidth. Whether we experience a scarcity of money or time or even social connection, other crucial resources, it drastically reduces our cognitive bandwidth. That's that precious mental capacity we need to reason clearly, focus intently, make sound long-term decisions, and successfully resist immediate impulses.
So scarcity actually drains our mental energy.
It does. Think of it as your brain's processing power being heavily diverted to address the immediate threat, the immediate lack. This scarcity effectively pushes us into what behavioral scientists have termed a cognitive tunnel. Inside this tunnel, we focus with intense, laser-like precision on immediate urgent needs like figuring out how to pay the next bill that's due tomorrow or where the next meal is coming from. But this intense focus often comes at the severe expense of our long-term financial well-being.
You can't see the bigger picture when you're stuck in the tunnel.
Exactly. It becomes incredibly challenging to engage in responsible, proactive, long-term financial behaviors. Things like diligently saving for retirement, investing for future growth, or even just planning ahead for next month. Why? Because our minds are completely consumed with the urgent demands of the present. This is particularly detrimental for those with already limited financial resources. It creates this vicious cycle that significantly impacts their overall well-being and makes it incredibly difficult to break free from that tunnel vision. Another pervasive psychological force constantly influencing us is present bias and the powerful pull of immediate gratification. This is fundamental. This is our deeply ingrained tendency to prefer a smaller, immediate reward over a larger, more beneficial future one, even if the future one is guaranteed.
Like the classic marshmallow test, but for adults with money.
Exactly like that. It's why we might opt for, say, $10 cash in hand today, even if we know a guaranteed $15 could be ours tomorrow if we just waited. It's a profoundly relatable human trait, often directly linked to impatience and our difficulty in vividly imagining future benefits. A survey cited in our sources, conducted by Lendedu, provided a stark, almost painful example of this in action. It found that nearly half of millennials admitted they prioritize eating at good restaurants over saving for retirement.
Wow.
Half, and perhaps even more startling, a full 27% actually spend more on coffee each month than they manage to save.
Ouch. That coffee statistic.
Yeah.
It really hits home for many of us, I suspect. myself included sometimes. It truly highlights how powerful that immediate satisfaction, those small daily treats can be, even when we intellectually know the long-term benefit of saving is demonstrably greater. It's that present bias winning out again and again.
Indeed it is. Then there's overconfidence as a significant barrier to prudent financial decisions. We humans often, and quite charmingly in some ways, believe we're better than average in various domains.
Like driving. Everyone thinks they're a great driver.
The classic example. Statistically, of course, this is impossible. Surveys frequently show figures like 93% of people believing they are better than average drivers, or another one cited. A whopping 68% of university teachers confidently believe they are in the top 25% of their profession. The math just doesn't work.
Right.
In finance, this pervasive bias can be quite dangerous. It can tragically prevent people from adequately protecting their homes, their belongings, or their families through sufficient insurance. Or it can stop them from accurately recognizing and mitigating their own investment risks. We simply, and often optimistically, assume that negative outcomes won't happen to us, or that we're somehow immune to the pitfalls others face. We think we'll be the exception. Furthermore, there's the often overlooked role of shame and avoidance, which significantly impacts financial health. This is a really important sensitive area. Feelings of inadequacy or shame, which are intensely socially derived emotions, can lead to lower confidence and, crucially, active avoidance behaviors regarding financial matters.
Just sticking your head in the sand, basically.
Exactly. People might actively avoid opening their bank statements, refuse to discuss their debt even with a spouse, or delay seeking financial advice because of these powerful, uncomfortable feelings. A study by Gerd Gigerenzer et al., mentioned in the sources, found something quite striking. A staggering 85–90% of people reported they would rather not know about upcoming negative events if they couldn't do anything about them.
Willful ignorance to avoid bad feelings.
Precisely. This profound aversion suggests a powerful willingness to embrace ignorance just to avoid negative emotions. And this directly hinders proactive financial engagement, especially with those less frequent but significantly impactful financial decisions like estate planning, retirement projections, or periodic investment reviews, things that require facing potentially uncomfortable truths. Now, shifting gears slightly, in this burgeoning digital economy, where so many of our financial interactions are now screen-based, often impersonal, building and maintaining trust in digital financial services is absolutely paramount, foundational. Users are exponentially more likely to adopt and consistently use new technology when they perceive adequate support, clear communication, and unambiguous signals of reliability and security. This isn't just a nice-to-have feature or a marketing tactic, it's a fundamental necessity for widespread adoption and sustained engagement, especially with something as sensitive as money.
That makes perfect sense. In a world that feels full of scams and data breaches, what kind of signals are we talking about here? How can these digital platforms effectively communicate trustworthiness to overcome our maybe justified skepticism?
That's a crucial question. These trust signals can include both tangible and intangible indicators. It's a multi-layered approach. Tangible ones might be things like highly visible security badges from reputable institutions like VeriSign seals or bank logos certifying the platform's security protocols. Genuine testimonials from satisfied customers, not just vague anonymous quotes, but maybe real stories or video clips can be powerful. And clear, immediate receipts or confirmations of successful transactions are vital. That little checkmark gives reassurance.
Yeah, you need that confirmation it went through okay.
Absolutely. Crucially, transparent access to customer service, knowing you can reach a human if something goes wrong, is huge. And clear, concise explanations are absolutely vital, especially at key moments. For example, if a digital service asks for sensitive information, like your national ID number or social security number, explain precisely why it's needed, what it will be used for, and how it will be protected dramatically builds trust rather than triggering suspicion.
Instead of just a blank field demanding info.
Right. Or, another example, if there's an unavoidable delay in a transaction, maybe due to back-end processing, providing brief details about why there's a delay and the expected resolution time can powerfully reinforce confidence and user buy-in. It manages expectations. These small, clear, proactive communications make an enormous difference in overcoming that perceived complexity and combating inherent distrust. So if we connect all of this back to the bigger picture, these deeply ingrained psychological tendencies, scarcity, present bias, overconfidence, avoidance, the need for trust signals, they mean that many financial products, even though they might be objectively needed for long-term security, aren't always desired by consumers in the moment.
Need versus want.
Exactly. Why? Because they frequently feel unattractive, overly complex, maybe a bit daunting, or simply irrelevant compared to immediate concerns and desires. The fundamental challenge for the future of finance, therefore, isn't just about creating new, shiny, innovative financial products or platforms using the latest tech. It's about ingeniously designing them for human beings, taking into full account all these cognitive quirks, emotional responses, biases, and limitations we've been discussing.
It's about empathy in financial design, really. Understanding the user's psychology.
That's a perfect way to put it. Empathy in financial design. That's key for 2030 and beyond.
Okay, let's dig even deeper now into the specific biases that influence us, especially perhaps with newer and often more volatile assets like cryptocurrency. It seems that even with the incredible amount of data and information available to investors today, human biases are still heavily shaping market trends, maybe even more visibly than ever.
They absolutely are. It's almost paradoxical, isn't it? Despite the manifold increase in access to information, sophisticated analytical tools, real-time data streams, investor biases continue to be profoundly pervasive. And, critically, they consistently tend to reduce overall market efficiency. They introduce noise and irrationality. As we move towards 2030, these behavioral biases are not just, interesting theoretical constructs. They are actively, heavily influencing investment decisions in markets around the globe, from established equities and bonds to nascent digital assets like crypto. Take confirmation bias, for instance. We touched on it, but it's worth revisiting its impact here. This is our insidious tendency to instinctively seek out, interpret, and remember information that exclusively confirms our existing beliefs or hypotheses. We filter reality to fit our views.
We love being right.
We do. Imagine you're invested heavily in a particular cryptocurrency, and you're utterly convinced it's destined to the moon, as they say. You will naturally gravitate towards news articles, social media posts, maybe expert opinions online that enthusiastically reinforce that bullish stance, while effortlessly discounting, rationalizing away, or outright ignoring any contradictory information that might suggest significant risk or problems.
Seeing only what you want to see.
Pretty much. This bias can profoundly undermine speculative decisions, especially in highly volatile, information-rich, and often misinformation-rich markets like cryptocurrency. It leads people to overlook crucial red flags and amplify potential risks because they're only getting one side of the story, the side they already agree with. And what's truly cutting edge here, moving beyond just surveys, is that researchers are now exploring objective biological signals. Looking at subtle changes in our heart rate, our skin conductance, basically how much we sweat slightly, to literally see when our brains are falling prey to biases like confirmation bias during financial tasks.
Using physiology to detect bias in real time.
That's the idea. It gives us a much clearer, potentially more objective picture of these internal struggles than just asking people how they feel or what they think they did, because we often don't even realize we're doing it. Then there's herding behavior, another classic in financial markets, amplified in the digital age. This is that powerful tendency for individuals to mimic the actions of a larger group, often without independent critical evaluation, even if those actions contradict their own private information, their own research, or even just plain common sense.
Safety in numbers, even if the numbers are running towards a cliff.
Sometimes, yes, that's the danger. We saw this famously with the meme stock manias we mentioned earlier. Large groups of retail investors piled into certain stock, not necessarily based on fundamentals, but because everyone else was doing it, and seemed to be making quick money. The social proof was overwhelming. We also see it with sudden, dramatic shifts in cryptocurrency prices, often driven by a collective movement fueled by social media sentiment or influential figures. And again, this isn't just about conscious decisions. Physiological data, things like heart rate variability, HRV, skin conductance level, SCL, even measuring stress hormone levels like cortisol from saliva samples, can provide objective behavioral indicators of our often unconscious responses to herding information. Are we getting stressed or excited by the crowd?
Our bodies react, even if our conscious mind doesn't register it immediately.
These biomarkers offer a unique window into our susceptibility to group influence, revealing when and perhaps how strongly we're being swept along by the crowd, physiologically speaking.
So in a way, our own bodies are providing this objective data, revealing when we're falling prey to these biases, potentially even before we consciously realize it. That's incredible. Mind-blowing, actually.
In a very real sense, yes. It's still early days for neurofinance, but these physiological responses give us a more objective, almost scientific window into the internal processes that drive our financial decisions, bypassing self-reporting biases. Next up, we have overconfidence and optimism. We touched on overconfidence as a general barrier, but in the specific context of investing, it's particularly potent. It leads to this extreme certainty in one's judgments, often far exceeding what the actual evidence supports, believing you know what the market will do. In new, highly volatile assets like Bitcoin or other digital currencies, where the future is inherently uncertain, this can manifest as an unrealistic, almost euphoric optimism about future gains.
Thinking you found the next big thing before anyone else?
Exactly. And crucially, a dangerous underestimation of the inherent, often significant, risks involved. The potential for massive, rapid losses that really define these volatile markets. Individuals might become overly confident in their ability to time the market perfectly or pick the winning coin out of thousands, completely ignoring historical data or statistical probabilities. They believe they have a unique insight or maybe just a lucky touch that somehow shields them from the risks everyone else faces. It's also crucial, especially when talking about new technologies like crypto, to consider the demographic factors influencing adoption. It's not just about psychology in a vacuum. Research, including studies conducted in places like Indonesia cited in our sources, consistently highlights that specific demographic factors play a remarkably significant role.
Like what kind of factors?
Things like age, education level, income, and overall technological proficiency or comfort level with new tech. These strongly correlate with individuals' behavioral intentions to actually adopt something like cryptocurrency. Specifically, data often shows, though these are generalizations, of course, that males tend to be slightly more inclined towards adoption than females.
Any theories why?
Well, the research suggests it might be due to varying culturally influenced levels of financial literacy, or perhaps different perceptions of risk, or even just different social network influences related to finance and tech. Generally speaking, younger, more highly educated individuals with higher disposable incomes and greater technological proficiency tend to be much more aware of cryptocurrencies and, consequently, more likely to investigate and potentially adopt them. Awareness is the first step.
So it's not just our inherent biases operating in isolation, but also our background, our access to knowledge, our comfort level with technology. All these shape our willingness to jump into these new financial waters. It's complex.
Exactly. It's a mix of psychology and sociology, really. And financial literacy is a profoundly crucial component tying it together. It acts as this empowering force. It helps individuals not only understand the potential benefits of something new, but also, critically, to more accurately assess and mitigate the perceived risks associated with these new financial technologies. Without a solid foundation in financial literacy, the perceived complexity of new digital currencies often leads straight back to distrust, hesitation, and ultimately slows down widespread adoption. That barrier we talked about.
Knowledge reduces fear and builds confidence.
Precisely. And let's not forget the power of social influence. We are social creatures, after all. Individuals who hold positions of authority or are considered opinion leaders in a community, or simply people whose opinions we value, like respected peers or family members. They can significantly encourage the acceptance and use of things like cryptocurrencies through their endorsement, their example, or even just talking about it positively.
So if your friends are doing it, you're more likely to consider it.
Absolutely. Social proof is powerful.
Okay, this raises a truly important question then. How can we as individuals become more acutely aware of these pervasive biases, confirmation bias, herding, overconfidence, and perhaps make more rational, or at least less irrational, financial decisions in a market that so often feels driven by raw emotion, groupthink, and fleeting online trends? It often feels like an uphill battle against our own innate wiring.
It certainly can feel like a formidable challenge. Our brains evolved for a very different environment than fast-moving digital markets, but the path forward, I believe, lies in cultivating rigorous self-awareness and fostering independent critical thinking. Easier said than done, I know.
How do we do that practically?
Well, behavioral finance offers powerful tools not just to identify these biases after the fact, which is useful for learning, but increasingly, as we discuss with neurofinance, to explore their physiological underpinnings. Adding that layer of objective data that self-reported observations often lack. By understanding the brain's subtle, often unconscious responses to financial stimuli, maybe through biofeedback in the future, who knows, we can gain invaluable insights. Insights into when and how these biases are most influential in our personal decision-making process. Are you more susceptible when stressed? When excited?
Allowing your triggers.
Exactly. This deeper understanding is key to developing more effective personal strategies to counteract them in real time, or at least to pause before acting on them. It's about knowing your own financial brain almost intimately, its strengths and weaknesses, to become a more resilient and hopefully more rational financial actor over time.
Okay, that's a lot about understanding our internal landscape. Now, since changing our fundamental motivations and deeply ingrained psychological wiring can be incredibly difficult, maybe almost impossible for some things, it feels like trying to change human nature itself. What about a different approach? Can we simplify the decisions themselves through cleverly designed nudges and, importantly, ethically engineered behavioral interventions? Can these seemingly small prompts, these subtle changes in how choices are presented, truly make a profound difference in our overall financial health without us having to become psychological superheroes?
Yes, they absolutely can, and the evidence base for their effectiveness is incredibly compelling and continues to grow rapidly across many domains. The core concept comes from the power of nudge theory, a framework built directly on the foundational work of Kahneman and Tversky on heuristics and biases. Nudge theory focuses on identifying those mental shortcuts or heuristics that we humans naturally employ, often unconsciously, and then subtly influencing behavior through low-cost or even no-cost interventions. The genius of it lies in simplifying the decision-making environment. It aims to make the desired beneficial choice the easiest, most frictionless one to make. Crucially, though, without restricting other options or forcing anyone's hand, freedom of choice is maintained.
So it's not about coercion. It's about making the good choice the path of least resistance, like putting fruit at eye level in the cafeteria instead of the cookies.
That's the classic example, exactly. It's about making the healthy financial choice feel almost effortless, almost automatic. And its effectiveness has been demonstrated with numerous, often quite astonishing examples across different sectors. In the public sector, for instance, we've seen General Electric use behavioral economics principles, nudges, essentially, to triple the success rate of its smoking cessation policies. Over 150,000 employees successfully quit smoking. That's huge public health impact.
Wow, triple the success rate just through behavioral design.
Yes. And another truly powerful example often cited is organ donation rates. This one is stark. In countries where citizens are default donors, meaning they are automatically opted in to donate unless they proactively choose to opt out, the donation rate averages a remarkable 90%. Conversely, in countries where organ donation is a proactive, opt-in decision, you have to actively sign up. The rate hovers at just over 10%, sometimes 15%.
That difference is staggering. Just changing the default.
Exactly. The default option, a simple nudge, dramatically changes life-saving outcomes by overcoming inertia and the tendency to just not get around to it. And in financial services, we've witnessed equally remarkable successes using these principles. Her Majesty's Revenue and Customs, HMRC, in the UK, their tax authority, redesigned its tax collection letters using behavioral nudges. Simple things like mentioning that most people in their area paid on time.
Using social proof.
Precisely. And this simple change significantly increased timely income tax payments, saving the government considerable collection costs. Perhaps the most famous UK example is the Pensions Automatic Enrollment Scheme. This is a game changer. By making saving for retirement the default option for employees, you're automatically enrolled unless you actively opt out. Participation in workplace pension schemes dramatically boosted. It went from around 55% before the scheme to a staggering 87% afterwards. Millions more people are now saving for their retirement simply by changing that default setting, overcoming procrastination and inertia.
That's potentially life-changing for millions down the line.
Absolutely. Another case study. Automatic enrollment into overdraft alerts, just simple text messages warning you you're about to go overdrawn reduced bank charges by a significant 25% for 1.5 million consumers across 6 major banks. Just an alert. Ideas 42, a leading behavioral science nonprofit, found that behaviorally framed SMS messages, wording them carefully based on psychological principles, increased new female signups for JazzCash mobile accounts in Pakistan by up to 64% more than standard marketing efforts. Tailoring the message matters. And their one-on-one financial health checks, structured as simple phone appointments, helped participants save 34% more on average.
How did those work?
They directly addressed common psychological barriers like limited attention by having a dedicated appointment, procrastination by setting a specific time, and present bias by helping people visualize future goals. These aren't just minor tweaks around the edges. They represent genuinely impactful shifts in financial behavior, driven by understanding psychology.
These examples are truly powerful. It really makes you realize just how much potential there is to genuinely improve people's financial lives through these seemingly small, intelligent changes in how choices are presented or supported.
It's quite inspiring, actually.
It is very inspiring. But it's also crucial we acknowledge both the limitations and potential unintended consequences of nudges. They aren't a magic bullet for everything. While they are incredibly effective for initiating short-term direct behavioral changes, getting someone to sign up or pay on time this time, there's actually limited evidence that nudges, when used in isolation, fundamentally alter underlying motivations or sustain long-term, deeply embedded behavior change across all contexts.
So they change the action, but maybe not the underlying attitude or habit.
Often, yes. They typically don't change deep-seated attitudes or values on their own. And crucially, they can sometimes have unexpected, sometimes negative side effects. We need to watch for those. For instance, that automatic enrollment into retirement savings in the USA while boosting savings overall, which is great, also led some participants, research found, to borrow more elsewhere, like for car loans and mortgages.
Why would that happen?
Well, the theory is perhaps they felt they had more flexibility or permission in other parts of their budget, now that retirement saving was taken care of automatically. Or maybe they mentally compartmentalized it. It shows behavior is complex. This brings us squarely to the crucial ethical considerations in behavioral interventions. Using psychology to influence people carries real responsibility. The OECD, among others, has thoughtfully outlined some clear principles for good practice here. Firstly, transparency is absolutely paramount. Interventions and their explicit purpose should be as transparent as possible given the desired outcome. People should ideally understand how and why their behavior is being influenced, and critically, that they always retain freedom of choice. No manipulation.
So no hidden tricks.
Ideally, no. Secondly, stakeholder involvement is vital. This is really important. It's not enough for experts or policymakers to design interventions for people from afar. You must actively engage the affected populations in the design phase, especially vulnerable or marginalized groups. This ensures interventions are inclusive, culturally sensitive, contextually appropriate, and genuinely resonate with the people they are intended to help. It prevents unintended harm and ensures the intervention is truly suitable and respectful. Co-design is key.
Designing with people, not at them.
Beautifully put. Thirdly, there's the critical need for mitigating risks. We talked about unintended consequences. Clear, robust protocols must be established before launching an intervention for identifying and proactively managing potential negative side effects, both generally and for specific subgroups. A classic example often cited in policy circles is the Ban the Box initiative in the U.S.
What was that?
The goal was noble. Help people with criminal records find employment by removing the checkbox, asking about criminal history from initial job applications. While well-intentioned, some research showed it inadvertently led to negative employment consequences for other minority groups, specifically young African-American and Hispanic men without criminal records.
How could that happen?
The hypothesis is that some employers, lacking explicit information about criminal records, may have resorted to statistical discrimination or implicit biases based on demographics, harming the very groups the policy aimed to help, alongside others. It shows complexity.
Wow, that's a sobering example of unintended consequences.
It is. Fourthly, and fundamentally, fairness, equality, and dignity must be rigorously preserved at all costs. Interventions must never, under any circumstances, promote discriminatory behaviors, stigmatize disadvantaged populations, or create unfairness in how they are applied or randomized. This demands careful, empathetic consideration of equity. And finally, thinking about lasting change. For truly sustained behavior change, interventions need to align deeply with individuals' existing identities and strongly held values. This is subtle but crucial. People need to recognize a genuine personal benefit, a clear, what's in it for me, beyond just being told something is good for them. And they need to feel that the new behavior is consistent with who they perceive themselves to be, with their self-image, to be genuinely motivated to internalize and maintain these new behaviors long-term.
So a simple nudge won't create lasting change if it doesn't somehow connect with their core sense of self or values.
Exactly. It might get temporary compliance, but not deep, lasting change, unless it resonates on that deeper level.
What's truly fascinating here, listening to all this, is how profoundly these subtle behavioral interventions can shape our choices, our finances, our health. Yet also the deep ethical responsibility that comes with wielding that power to influence human behavior. It's an incredibly powerful tool, but one that clearly demands immense care, thoughtfulness, and a holistic understanding of the bigger picture.
Absolutely, you've hit the nail on the head. A truly effective, ethical, and enduring approach to improving financial well-being must be holistic and multifaceted. It needs to strike a careful, conscious balance between facilitating those individual behavioral changes using nudges and smart design, and implementing wider systemic adjustments maybe in regulations, market structures, or educational approaches. This means integrating those clever short-term tactical nudges within a coordinated, comprehensive, long-term strategy. A strategy that also diligently addresses building skills, improving knowledge access, shifting mindsets where appropriate, and acknowledging the crucial role of social identity and context. Ultimately, it's about designing a supportive, human-centric financial environment where people can genuinely thrive, not just react passively to prompts or struggle against systems not built for them.
Right, creating an ecosystem that supports good choices. Okay, let's take these powerful behavioral insights now and connect them directly to one of the most talked about and perhaps most disruptive changes on the horizon for the future of money. I'm talking about central bank digital currencies, or CBDCs, and the broader landscape of digital assets like cryptocurrencies and tokenized assets. How does psychology specifically influence their adoption? And what unique behavioral challenges lie ahead in making these new forms of money truly work for and be embraced by everyday people around the world?
This is absolutely a critical frontier where human behavior, human psychology will undoubtedly dictate the success or, indeed, the potential failure of these major initiatives. Let's first look at the compelling drivers for CBDC adoption, at least from a central bank or government perspective. Why are they even exploring this? There are several powerful reasons outlined in the research. Firstly, CBDCs have the significant potential to reduce payment costs and dramatically enhance the efficiency of digital payments overall, making transactions faster, cheaper, maybe more seamless.
Cutting out intermediaries, perhaps.
Potentially, yes, or streamlining the process. Secondly, they present a monumental opportunity to encourage financial inclusion, especially in underserved regions globally where existing banking systems are poorly developed, expensive, or inaccessible to large parts of the population. A CBDC could give people direct access to digital payments. Furthermore, central banks see CBDCs partly as a way to maintain monetary policy effectiveness and control in an increasingly digital, potentially fragmented payments world. And they could provide convenient, potentially cheaper access to other currencies for things like international remittances, a huge market, or cross-border travel and trade. So there are strong potential benefits on paper.
Okay, so on paper, CBDCs seem to offer a lot of compelling advantages, especially around efficiency, inclusion, maybe even modernizing the whole system, addressing some long-standing issues. But what about the human side? What are the behavioral hurdles? Why aren't people necessarily just jumping on board immediately with something that sounds potentially beneficial?
That's precisely where the behavioral barriers become starkly apparent, and they are significant. A major one is simply deeply ingrained habit persistence, status quo bias. A significant portion of consumers, according to various surveys across different countries, consistently report they are unlikely to adopt CBDCs. Why? Often due to a strong, almost automatic preference for their existing familiar payment methods, whether that's physical cash, debit cards, credit cards, or established mobile payment apps like Apple Pay or Venmo.
People just stick with what they know.
Exactly. People are comfortable with what they know and use daily. The psychological switching costs, the effort, the learning curve, the uncertainty are real, even if the financial costs are low. Then there's the critical factor of financial literacy and education. This keeps coming up, doesn't it? Individuals with higher levels of financial literacy and formal education are, quite predictably, far more likely to actively learn about and potentially adopt CBDCs.
Why is that?
Because their information acquisition costs, basically, the mental effort and time required to understand something new and complex like a CBDC are inherently lower. They might find it easier or less daunting to learn about it. This means that widespread, clear, simple, and accessible efforts to enhance financial literacy around digital currencies are absolutely essential for achieving broader CBDC adoption. People don't understand what it is, how it works, why it benefits them, and, importantly, that it's safe, they simply won't use it. Or they'll be suspicious. Another extremely significant factor is perceived risk and the impact of negative sentiment. This is huge for adoption. Perceived risk, whether it's about security, privacy, government surveillance, or just the risk of the technology failing, is a statistically significant and powerful factor influencing the behavioral intention to adopt any new digital currency.
Fear of the unknown, fear of being tracked.
All of those. And what's particularly striking from our sources is how potent negative media sentiment is. Negative news stories, or even just online chatter surrounding early CBDC pilots, for example, reports mentioning glitches or low uptake with Nigeria's Naira, the Bahamian sand dollar, or the ECCB's Dcash in the Eastern Caribbean. This negative sentiment directly correlates with reduced adoption intentions elsewhere. Bad news travels fast and wide in the digital age.
And sticks in people's minds more than good news.
Research suggests yes. This negative sentiment often has a greater, more lasting impact on hindering adoption than positive sentiment has on driving it. We have a negativity bias. And related to this, new financial products, by their very nature, are frequently perceived by customers as more complex and tedious than they perhaps actually are. This perception gap increases distrust and significantly slows down adoption. It's a psychological inertia that needs active effort to overcome.
That makes perfect sense. If the news cycle is filled with concerns about privacy or technical problems, or if the whole concept simply seems complicated and intimidating, most people will naturally just stick to what they know and trust cash, cards, PayPal, even if the new CBDC option is objectively more efficient or beneficial in some ways.
Precisely. So how can central banks and governments effectively overcome these inherent behavioral barriers? It's a massive communication challenge. Effective, clear, simple, and empathetic communication strategies are absolutely crucial. It's not just about technical specs, it's about connecting with people. Providing clear, simple, and concise information about digital payment programs helps potential recipients understand the changes and adapt their behavior proactively. Tell them what's in it for them. But it's not just what is communicated. How it's communicated is paramount. The medium and the message style matter immensely.
So not just dense policy documents.
Yeah, definitely not. Research consistently shows that video treatment's short, engaging videos, especially those with local language voiceovers and subtitles, lead to much stronger adjustments in consumer expectations and higher adoption rates than purely text-based information like FAQs or websites.
Seeing is believing, or at least understanding.
Exactly. Visuals make complex monetary policy communication or explanations of new tech much more relatable, more digestible, and significantly increase trust. Showing people how to use these new systems, demonstrating their ease and security, perhaps through relatable everyday scenarios, is far more impactful than just abstractly telling them about the benefits. Now, beyond CBDCs specifically, let's briefly look at the broader landscape of digital assets, cryptocurrencies, stablecoins, tokenized real-world assets. This landscape, according to the KPMG report, has matured significantly since what many in the industry vividly remember as the great crypto crash of 2022 and the subsequent crypto winter.
Things got pretty bleak there for a while.
They did. But since then, a combination of factors, more thoughtful and incremental regulation emerging in key jurisdictions, coupled with greatly enhanced market infrastructure, better custody solutions, improved security protocols. All this has led to somewhat greater stability, maybe less wild volatility, and importantly, an innovation boom in areas like the tokenization of assets. Digital assets, while still evolving and carrying risks, are now steadily becoming a more trusted and increasingly accepted component of mainstream financial markets, not just a fringe speculation.
So moving beyond just Bitcoin speculation.
Yes, offering potentially new and diverse sources of investment for both retail and institutional portfolios. Think tokenized real estate, bonds, art. And the underlying technologies, like blockchain and distributed ledger technology, DLT, have also created potential for unprecedented operational efficiency for fund managers and financial institutions, streamlining complex back-end processes like settlement and reconciliation. This all signals a future, potentially, with diverse parallel payment networks and asset structures existing alongside traditional ones, where purpose-built digital units of exchange facilitate entirely new products, services, and maybe even entirely new economic models, fundamentally redefining what money or value can be and how it moves.
Okay, if we try to connect all of this back to the bigger picture theme, it really seems the future of digital money, whether it's CBDCs or other digital assets. It isn't just a technological race or a regulatory policy debate, though it's both of those things too. Fundamentally, it seems to be a psychological one. How do we ensure these incredible technological advancements actually serve human needs, fit into our lives, and integrate seamlessly with our behaviors, rather than just existing as impressive technological marvels that most people are hesitant, confused about, or even actively resistant to adopting?
That's the core challenge, isn't it? And it's beautifully complex, sitting right at the intersection of technology, economics, and psychology. The key, I strongly believe, is designing these new financial instruments and the entire systems around them with human psychology placed squarely at the forefront of the design process, rather than building the tech first and then trying to force human behavior to adapt to it, which rarely works well.
Build it for humans from the start.
Exactly. This means making them intuitively easy to use. Simplicity is key, making them inherently trustworthy through transparent design and clear communication, and making the benefits demonstrably clear and relevant to the end user. It requires thoughtfully addressing our inherent cognitive biases like loss aversion or status quo bias. It means understanding our deeply ingrained habits, acknowledging our natural risk aversion, and addressing these through intelligent design choices, clear and ongoing communication, accessible education, and robust user support. Ultimately, it's about actively, consciously bridging that often wide gap between what technology makes possible and the nuanced, often quirky, sometimes irrational reality of human behavior. It's about making the future of money truly human-friendly, not just tech-friendly.
Human-friendly money.
Yeah.
I like that. Okay, for our final and perhaps most provocative thought in this deep dive, looking even further ahead than 2030, let's consider a truly mind-bending idea that came up in one of our sources. What if? What if, in an age of truly advanced artificial intelligence, money as we know it?
Wow.
This fundamental concept that has shaped human society, conflict, cooperation, everything for millennia, what if it simply becomes meaningless?
Yeah.
It's a concept that challenges the very foundation of our economic systems, our social structures, even our sense of individual worth. It's almost hard to grasp.
It is indeed, and it's a fascinating, almost sci-fi concept articulated in a piece provocatively titled "The Day Money Die: AI's 2030 Economic Tsunami." It's definitely out there thinking, but worth considering. This perspective suggests that truly advanced AI, perhaps artificial general intelligence or something close, could potentially usher in an unprecedented era of abundance. Radical abundance, fundamentally disrupting existing economic systems that, for thousands of years, have been built entirely on a foundation of scarcity of resources, scarcity of labor, scarcity of time.
How would AI create such abundance?
Well, the idea is, if AI can eventually design, produce, and distribute nearly everything we need, from physical goods manufactured by automated systems to complex services like medical diagnosis or education with minimal human input, then the entire basis of our current economic exchange, which relies on trading labor or capital for scarce goods and services, could potentially dissolve. If everything is virtually free, what's the point of money? In such a future, the source speculates, real wealth might be radically redefined. It could move far beyond mere material accumulation or the numbers in your bank account. The focus could profoundly shift towards intangible yet deeply profound human values like, and I quote, a loving family, strong social bonds, and a solid moral foundation.
Things money can't buy, essentially.
Exactly. In this speculative scenario, purpose could genuinely become the new currency, and contribution to the community or to human knowledge could become the new status symbol. The fundamental question we ask each other might transform from what do you earn or what do you own to something more like how do you contribute or what value do you create. This echoes, interestingly, ancient wisdom found in texts like Ecclesiastes in the Bible, which reflect on the ultimate vanity of chasing material wealth compared to the enduring value of relationships, wisdom, and meaningful work.
Here's where it gets really interesting for me. This isn't just a change in how we transact or what we save for. It sounds like a complete reevaluation of what gives our lives value, what motivates us, what drives us as human beings. It implies not just an economic shift, but a massive psychological and societal transformation at our very core, maybe the biggest in human history.
Exactly. It could be that profound if this scenario ever came to pass. For millennia, humanity has been profoundly shaped, psychologically and socially, by the relentless struggle against scarcity. This struggle has influenced our core values, our social structures, our tribalism, our definitions of success, our very identities. So much revolves around acquiring and protecting resources. Advanced AI, by potentially offering a world of fundamental abundance where basic needs are met for everyone almost effortlessly, could force a profound, almost existential shift in our collective values and our individual sense of self. If the daily struggle for basic survival, which has defined most of human history, is no longer our primary driver, what then?
What do we do all day?
Right. We will inevitably be compelled to answer a deeper, more profound question. Who do we want to be, collectively and individually? This isn't just an economic or technological shift. It's a deeply human one that challenges the very core of our being. It pushes us to redefine what it means to live a meaningful, purposeful life when the old metrics of money and accumulation might become obsolete. It's a compelling, almost overwhelming prospect to even contemplate.
That's a truly powerful thought to leave us with.
a potential future where our inherent human value, our connections, our creativity, our contributions truly become the ultimate measure of wealth and success rather than simply financial accumulation. It completely flips our current understanding of achievement and maybe even what it fundamentally means to be human completely on its head. Wow. Okay, what an incredible deep dive this has been. Seriously, we've covered a vast amount of ground today. We navigated from the rapidly evolving financial landscape, driven by that relentless digital transformation and a new era of profound customer centricity, to the deeply ingrained human psychological principles that subtly, and sometimes not so subtly, shape every single one of our money decisions. We've explored the subtle yet powerful influence and the critical ethical considerations of behavioral nudges designed to help us make better choices. And we journeyed through the complex, often volatile, but undeniably important landscape of digital currencies, from CBDCs to the wider world of crypto assets.
It's clear, I think, that while the future of money is certainly complex and undoubtedly filled with uncertainty, maybe more than ever before, understanding financial psychology offers truly practical, accessible solutions to help navigate it, both on a grand systemic level for policymakers and institutions, and perhaps more importantly, on a personal level for each of us trying to manage our own financial lives. There's immense empowerment, I believe, that comes from understanding both the powerful external trends shaping our financial world and the often unseen internal biases and tendencies that shape our own choices within that world. The goal here, as we've discussed, is not really to attempt to eliminate emotion from finance. That's probably an impossible and perhaps even undesirable task for us humans. Emotion drives action, after all. Instead, the goal is to deeply understand it, understand our own psychology, and then to use that understanding to design financial systems, products, and personal strategies that work with our inherent human nature, rather than constantly struggling against it or being tripped up by it.
Working with our wiring, not against it. And as we wrap up this fascinating conversation, here's a final provocative thought for you, our listener, to perhaps ponder long after this deep dive ends. Money, in all its myriad forms and functions throughout history, has always been, at its heart, a symbol of value, of trust, of exchange. As we've explored today, looking towards 2030, and maybe even far beyond, what we truly value deep down and how we choose to contribute to our communities and the world around us, that might just be the most important currency we possess. What will you choose to invest in? Beyond just dollars and cents, beyond Bitcoin and stocks, what holds true value for you? Thank you so much for joining us on this deep dive. We truly hope this conversation has sparked some profound aha moments for you, maybe left you with some clarity or at least some interesting questions and a fresh perspective. We absolutely love hearing your thoughts, really, so please share your insights, your own aha moments in the comment section wherever you're listening. And if this deep dive resonated with you, please share it with friends, family, colleagues, anyone who might be curious about the psychology and the future of money. Your insights genuinely enrich this ongoing conversation, and we love hearing what stands out to you. Until next time, keep digging deeper into the fascinating world around us.